Hello, traders and investors. Welcome back to our series on financial markets. Today, we're delving into the advanced aspects of exchange-traded notes, or ETNs. So, buckle up and let's get started. First, let's recall what ETN are. They're unsecured debt securities that track an underlying index or asset. Unlike ETF, ETN don't hold the actual assets, but rather they promise to pay the returns of the index they track. Because they're backed by the credit of the issuer, not by assets, ETN carry a significant credit risk. In the event of the issuer's bankruptcy, as we saw with Lehman Brothers in 2008, ETN holders can lose their entire investment. One of the intriguing features of ETN is their flexibility. They can track a broad range of assets, from broad market indices to individual commodities, or even exotic assets like volatility itself. This gives investors numerous opportunities to diversify and explore alternative asset classes. The taxation of ETN is another important aspect. Unlike ETF, ETN do not distribute dividends or realize capital gains annually, thus delaying any tax implications until the sale of the ETN. This could provide potential tax advantages for some investors. ETN come with a maturity date, typically after 30 years. At this time, the issuer will pay the investor the value of the note, which is linked to the performance of the underlying index. However, some ETN have an early redemption feature. It allows the issuer to return the principal before the maturity date under certain conditions. It's essential to understand these terms before investing. Every trading day, issuers publish an indicative value for ETN, which is meant to reflect their intrinsic value. However, the market price of an ETN can diverge from its indicative value due to supply and demand dynamics in the market. Investors should therefore monitor both the indicative value and the market price. Another concept crucial in understanding ETN is the tracking error. Ideally, an ETN would perfectly mirror the performance of its underlying asset, but in practice, this is not always the case. Tracking error refers to the divergence between the ETN performance and the performance of the underlying asset. Factors contributing to tracking error can include management fees, transaction costs, and the previously mentioned supply and demand imbalances. In conclusion, while ETN can offer a variety of investment opportunities, they come with their own unique set of risks and considerations. It's crucial for investors to understand these nuances before diving in. That's it for our deep dive into ETN. If you found this video insightful, please give it a thumbs up and don't forget to subscribe to our channel. As always, leave any questions or comments below. Stay tuned for more episodes. Happy investing!